Hey everyone, if you're thinking about investing in Disney stock, or maybe you're already invested in Disney stock, one of the biggest risk, in fact, the biggest risk with the company is the decline in the linear network business. So just how bad is it? That's what I wanted to talk about in this video, provide further insight into that decline of Disney's linear network business as described by the company's interim CFO. So at Linear Networks, operating income declined versus the prior year by 580 million, driven by declines in both domestic and international channels. While domestic linear advertising revenue declined year over year, ESPN ad revenue increased by 4%, demonstrating the relative strength of sports. And that's really what's keeping many people subscribed to cable or subscribed through satellite connections to ESPN and the cable bundle, as it's known, is live sports. You still have difficulty getting the quality and quantity of live sports on other services compared to what you can get through the cable subscription. And that's really what's keeping people connected for the near term. But for longer term, that cord cutting is happening, and it's happening more and more rapidly. And that's unfortunate for Disney and Disney stock investors because that segment of the business was lucrative, generating operating profit margins above 20% and generating billions of dollars of cash flow for Disney. So linear advertising continues to see impacts from market softness, while sports remains healthy. Entertainment continues to face headwinds. And again, sports is shining here because sports is one of the few programming that remains, well, where people watch it live as it's happening. Right? You think about that used to be shows that were airing on prime time at 7 p.m. on a Friday evening. Advertisers could count on people watching it on Friday night at 7 p.m. when that show would air. But more and more so, people are recording it, watching it later, or watching it on another service when it comes out on a streaming service eventually. And advertisers can't count on that viewer being there in front of the screen watching that show at that time. Sports, however, they can still count on it. And so that's where advertisers are attracted to sports, knowing that they've got an audience that's going to be there, that's going to be captivated. They're going to be watching. They're not going to want to tune out in the middle of the fourth quarter with the game on the line and the outcome uncertain. And so that's still attractive for marketers, but entertainment continues to not be so much so. Domestic linear network affiliate revenue decreased by 2% from the prior year due to a 6-point decline from fewer subscribers, partially offset by 4 points of growth from contractual rate increases. And so as people are canceling those subscriptions, Disney is trying to offset that by raising the fees, raising the contractual fees that they're charging network affiliates to offset that. And they're having success to some degree, right? From 6% decline in subscribers to a 4% growth in contractual rate increases, but still the revenue decreases 2% as a result. And so it's challenging for Disney to try and offset that. Meanwhile, the more they raise prices, the more they encourage folks to cancel that cable subscription and go to streaming completely instead. So a really challenging scenario for Disney and Disney management to transition from this lucrative business model over to the streaming business model. Longer term, however, Disney can be encouraged by the fact that demand for its products remains high. People still want to watch Disney's content. Sports is still extremely popular. They've just got to transition over to the streaming consumption model. And you can look at Netflix for encouragement. Netflix, before this competition entered into the streaming industry in recent years, had reached an operating profit margin above 20%. So it can be done, it can be achievable. It's just a matter of making that transition and making it stick. All right, so it's pretty bad for Disney in the linear segment, but there is a light at the end of the tunnel. Once the company makes the transition complete, it can focus on the streaming segment and generating those 20% operating profit margin in that segment instead. All right, but that's it for this video. Thank you for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.